Hey everybody, what's up? Welcome to episode 6. In today's episode, we'll continue with the topic of support and resistance, supply and demand, and we'll combine that with trends and we'll repeat some of what we learned so far in this series. We already spoke about trends and trend lines a few weeks ago, so you already know that a trend is the kind of price action that's going to make you money. You will buy at some price, say $10. The price will continue upwards, 11, 12, 13, 14, and you will then sell for a profit at $15, as an example. Or you sell short at 100, the price will trend downwards, 99, 98, 97, 96, and you will buy to cover at 95 and make money. That's simple, right? Earlier, we also concluded that the markets move in waves. In an uptrend, you will have price moves or pushes upwards, and then price moves, retracements downwards. This is true on every time frame and in both upwards and downwards trends. The market never goes straight from one point to another, even if it sometimes looks like the market moved down in a straight line. When you look at a historical 5-minute chart, for example, there would have been a lot of fluctuations up and down during that move, especially if you watch the same market at the same time in a lower time frame, for example a 1-minute chart. So when you have these waves moving higher and higher, this price action will form a trend, and you can use lines to draw simple trend lines, which is the idea behind these diagonal support and resistance lines or levels. So the idea behind trend lines, it's straightforward. We just connect the dots. When there's underlying demand for the stock, for the currency, futures contract or commodity, or whatever you're trading, because this is true for any traded security, the prices will increase when there's underlying demand. The demand forces the prices upwards with certain momentum until the demand diminishes, or a force of supply that is strong enough changes the direction of the price movement. And we can see that the demand is diminishing as the price bars or candles arch over or flatten out, consolidate. When this happens over and over again, we will get low points and we'll get high points. We'll use these to draw the trend lines, support line in an uptrend together with an overbought line parallel to the support line. Then when a growing force of supply becomes significant enough, it will drive prices downwards until the force of supply is exhausted, or if there's new demand coming into the market. Then prices tend to round up or level out. When this happens a few times in a row, we get two high points that we use for drawing the resistance line and an oversold line parallel to the resistance line. And now that we have those parallel lines, we see that they form a channel, an uptrend channel or a downtrend channel. And the way we use trend line channels in day trading price action is both as a trading signal and as a filter. We will have a way to avoid entering trades when the circumstances are not right for trading. So, like we did in episode 3, we draw a trend line. In this case, a support line or a demand line. There are always many different terms, different market terminology that's used. I like to use the term support line when drawing a trend line to indicate an uptrend. So we draw the support line through two lows, then we draw the overbought line parallel to the support line through the high between the two lows that we used for the support line. And in a downtrend, you use the same principles. You find two highs, you draw the resistance line through those, then find the low between those highs and draw the oversold line through that low parallel to the resistance line. So these two lines now form a channel, a range with an upper boundary and a lower boundary. And we expect the market to continue moving inside this channel, of course, until it breaks out of it. And that can happen sooner or later, or the market can stay in the channel for a long time. The significance of trend lines and channels that fail, it's not just that the trend line is broken, but you need also to analyze how and under what circumstances this channel or these lines are broken. So a move down through a support line, that can just be a test or it can be a shakeout. Now the shakeout, that's a form of market manipulation where large market operators artificially push the prices down to shake out traders out of their positions. Traders who have bought now believe that the market is going to move down, but that move is just designed to shake those weak holders out of their positions. In other words, scaring these traders into selling. Now these price moves are often called springs when they occur in uptrends and upthrusts when they occur in downtrends. And they are usually very good trading signals, but it is difficult to trade them as it will feel counterintuitive to go long when the market seems to go down. Another way you would use an uptrend channel for trading is either to buy as the prices bounce off of the support line, or to sell short as the prices bounce off of the overbought line. At the overbought line, you want to see the prices arch over or flatten out. You want to see shorter, smaller candles and diminishing volume. This signals that the demand is drying up for the time being and the market is likely to move downwards from here. And at the support line, you want to see the prices round up or level out. As the price starts to move upwards again, you want to see an increase in volume, bigger candles, which tells you that the demand is again becoming stronger and stronger. Another way to use the channel for trading is to sell short as the market breaks the support line. But you don't want to sell short immediately because that will lead to a lot of losing trades, because there will be false breakouts happening all the time. You should instead wait for 2 consecutive closes below the support line, or better yet, wait for a retracement up to the support line, as the market is likely to try to test these levels again to see if there's still demand to go higher to again move into the channel. You want to see a big red candle, high volume on the breakout, because that tells us that there's a lot of supply entering the market. The sellers are in control. Then when the retracement occurs, this should be on diminishing volume candles that get smaller and smaller. Same thing in a downtrend channel. You want to sell short as the price bounces off of the resistance line and buy when price reaches the oversold line. Here you also want to pay attention to the price action and analyze the candles. When the price approaches the oversold line, you should see smaller and smaller candles and lower volume. The candles will flatten out, round up. At the resistance line, you also want to see prices arch over and volume picking up as the down move begins. And when the market breaks through the resistance line, you want to see this happening decisively on a big candle and with big volume. It's safest to wait for a retracement after this breakout, as there's a risk that this is just a false breakout or an upthrust that tries to shake out traders or fool traders into buying right before the market starts moving down. The retracement should be on lower volume. The volume should be on the up moves. That tells us that the buyers are in control and we want to join those buyers and profit from the up move. Another way to use the price channels is to know when to be more conservative in your trade management. Say the market is in an uptrend channel and some trading strategy like the DayTradeToWin Atlas line, Trade Scalper, or at the open 2 signals a long trade close to the upper boundary of the channel, close to the overbought line. Now you can take advantage of the information that the trend channel gives you and perhaps take profits earlier as the market approaches the overbought line, or simply enter a smaller position in the first place. Or if you use some less accurate trading strategy other than the DayTradeToWin strategies, you may even want to filter out trades that signal at the boundaries, filter out long signals that occur at the overbought line, and filter out short signals that occur close to the support line. Same thing in a downtrend channel. Filter out long signals that occur close to the resistance line. Filter out short trades that occur close to the oversold line. And today we have again talked about volume. The analysis of volume is one of the foundations, one of the cornerstones in price action trading. So in the next episode, we'll go through the basics of volume analysis. It's going to be important for you to know and understand, so please make sure you subscribe so you get access to the next episode. Until then, take care. Bye bye.